The case I select is a Miller Energy Resources Inc. And those are the four respondents involved in the case. Here is an outline of my presentation. And then back to the case. This case involves financial accounting and reporting fraud, as well as audit failures related to the valuation of certain oil and gas assets acquired by Miller Energy. Miller Energy purchased oil and gas assets which located in Alaska for $2.25 million in cash, along with the assumption of certain liabilities. The company subsequently reported those assets at an overstated value of $480 million and recognized a one-time bargain purchase gain of $277 million. This valuation was based on a reserve report and an insurance replacement cost, which do not reflect fair value. The company also double counted $110 million of certain fixed assets that were already included in the reserve report. This overvaluation led to significant financial discrepancies and misinformed stakeholders about the company's true financial health. The acquisition was the single most important event in Miller Energy's nearly 40 years history, transforming it from a penny stock company to one traded on a national exchange. And then a little bit information about our first respondent in the case, Miller Energy. It is a Tennessee corporation founded in 1967. It operates and develops oil and gas wells in North and South Central Alaska. In 2009, it purchased oil and gas properties in Alaska for $2.25 million, but reported at $480 million in book. And then our second respondent, Boyd. He's 57, lives in Tennessee. Since 1993, he has been a licensed CPA in Tennessee. From 2008 to 2011, Boyd was the CFO and treasurer at Miller Energy. From 2011 to 2014, he was the director of risk management. And then our second respondent, Hall. He's 45, lives in Alaska. He has degrees in industrial and electrical engineering from Ruffle University. It is an online institution described as a legal supplier of educational credentials. Since 2009, Hall has served as a director in Miller Energy and CEO of its Alaska subsidiary, and as Miller Energy's chief operating officer since 2013. He has worked with the acquired Alaska assets since at least mid-1990s. Before joining Miller Energy, Hall served from 2008 to 2009 as vice president and general manager of Alaska operation for the immediate past owner of the acquired asset. In this capacity, Hall was the most senior employee in Alaska, responsible for the day-to-day operation of the oil and gas properties. Our last respondent, Vogt. He's 53, lives in New York. He's been a licensed CPA since 1998. He worked as a partner at Liggett and was previously a partner at Sharp & Co. LLP from 2005 to 2011. In 2008, August, which is 2 weeks after Miller Energy named the founder's son-in-law as CEO, Vogt was hired to become the company's auditor. Some background about Miller Energy. Between 2002 and 2009, Miller Energy stock price traded below $1 per share, falling to a low of 4 cents per share in December 2007, and reported net loss in all except 2004. For example, for fiscal 2008 and 2009, Miller Energy had cumulative over 5 million operating loss on just over 2 million revenue. In August 2008, Miller Energy named its founder's son-in-law, a former real estate agent, as CEO. Soon after that, the company began acquiring additional oil and gas properties. In the fall of 2009, Miller Energy became aware of the oil and gas properties in Alaska that were in the process of being abandoned as part of the bankruptcy proceedings. Unable to service its heavy debt and pay the significant monthly costs required to operate the properties, the bankrupt entity unsuccessfully sought for almost a year to sell its Alaska assets. Finally, it sold them to Miller Energy, and then the transaction closed on December 2009. On March 22, 2010, Miller Energy filed its quarterly report on Form 10-Q for its fiscal third quarter ended January 31st, 2010, and it reported a value of $480 million for the Alaska acquisition, which consists of $368 million for oil and gas properties and $110 million for fixed assets. It also reported an after-tax $277 million bargain purchase gain, which boosted net income for the quarter to $272 million, which is an enormous increase over the $556,000 loss reported for the same period the year before. The new book value of the Alaska acquisition significantly impacted Miller Energy's stock price. On the date of transaction, December 10th, 2009, Miller Energy's stock closed at 0.61 per share. By March 31st, 2010, Miller Energy stock closed at 6.60 per share and then reached at an all-time high price on December 9, 2013 of 8.83 per share, which is equivalent to $393 million. On April 30th, 2015, it got informed by New York Stock Exchange that it was in non-compliance with listing requirements. The next day, its stock price dropped to 73 per share, and it lost approximately $360 million in market capitalization from its 2013 high of $393 million.